What if I told you many Australians are not paying extra tax because the ATO made a mistake, but because they are not using the legal rules already available to them? Today, I'm going to show you 7 legal strategies to reduce tax, starting with the one that can begin with a single conversation. Australia taxes your income in brackets, tax-free up to $18,200, then 16%, 30%, 37%, and 45% above $190,000 for Australian residents in 2025 to 26. Most taxpayers also face a 2% Medicare levy. Medicare levy adds about $1,960 on a $98,000 taxable income, unless you qualify for a reduction or exemption. So as your income grows, income tax and the levy can take a bigger bite from every extra dollar. Say you earn $150,000. Your marginal tax rate is 37%, and after income tax plus the Medicare levy, your total bill is about $39,838. You keep around $110,162 before things like HECS, offsets, or deductions. You earn $85,000. Your marginal tax rate is 30%. Your income tax plus Medicare levy is about $17,988, leaving you around $67,012 before any other adjustments. Whether you are in the 30% or 37% bracket, that tax money could be funding your super, your mortgage, your investments, or your next big goal. How much of that tax could you legally reduce? Right now, you may be missing money you could keep working for your future. Let's find out how. Salary sacrifice lets you redirect pre-tax income straight into your super. If your employer offers it, your taxable salary can drop before your pay hits your bank account. Here's how it works. Before tax touches your bank account, a portion goes to super. Concessional super contributions are generally taxed at 15% instead of your marginal tax rate. For example, if someone in the 37% bracket sacrifices $15,000, the tax difference can be roughly $3,600 before extra rules. That is money redirected toward long-term wealth. Sacrifice $10,000 while you are in the 30% bracket. The tax difference may be around $1,700, depending on Medicare levy, caps, and your personal situation. Setting it up usually starts with one conversation with your HR or payroll department. Ask if they support salary sacrifice and how it will appear on your payslip. Concessional cap is $30,000 per year for 2025 to 26. Even if you are already getting employer super, you might still have room, but you must check first. Salary sacrifice is just the beginning. There are other strategies to multiply your tax savings. Stick around for the next one. You can claim deductions for work-related expenses, home office costs, and vehicle use, but only if they are genuine and you track them properly. If you do not claim legitimate work expenses, you could miss hundreds or even thousands in deductions. At a 37% marginal rate, every $1,000 deduction can reduce tax by about $370 before Medicare effects. If you track your home office setup, say a work desk, internet, phone, or software, you may be able to claim the work-related portion. Careful. The ATO looks closely at high deductions compared with your income and occupation, so do not exaggerate and do not guess. For your car, a logbook or proper record makes claiming stronger. Record your work trips and keep personal travel separate. Do not forget union fees, professional memberships, licenses, tools, subscriptions, and self-education that directly relate to earning your income. That is how you become a deduction detective. But there is another strategy that could supercharge your savings, coming up next. Let's supercharge your savings with smarter super contributions, paying less tax on money you send straight to your future. If you have $10,000 of cap room and you are in the top tax bracket, the tax difference can be about $3,200 before Division 293 or other rules. Even in the 30% bracket, $10,000 of concessional contributions could create a tax difference of around $1,700 compared with taking it as normal salary. Remember, your employer's 12% super guarantee counts toward that $30,000 cap, so check your total before adding more. What if you cannot afford to max out the cap? Do not worry, there may be a way to catch up on unused contributions. Up. How to use the carry-forward rule to make larger contributions from past years and potentially reduce your tax bill. Here is the carry-forward rule. Unused concessional cap amounts from previous years may be available to use in a later year. If you have not been using your full cap, your available amount could be much larger than 1 year's cap, but your exact number depends on your own super history. You can only use carry-forward concessional caps if your total super balance was under $500,000 at the previous 30th of June. This rule can be powerful for late starters, people with bonuses, business owners, or anyone having one unusually high income year. Check your unused cap in MyGov. Pulse urges you to log in and see your actual available amount before you contribute. Every dollar you put in may save tax now and grow in a concessional super environment, but it is usually locked away until retirement rules are met. Beyond super, your investments can reduce tax too. The 50% capital gains discount rewards waiting, not months, but at least 1 year. Hold an eligible investment for at least 12 months, and you may qualify to discount the taxable capital gain by 50%. That means only half the gain is added to your taxable income. Sell after just 6 months, and you may pay your full marginal rate on the whole profit. That can seriously hurt your after-tax return. Long enough to qualify, and the same gain may have only half counted for tax. That can save thousands, depending on the size of the gain. Do not churn your portfolio just for excitement. Frequent trading can trigger short-term gains and destroy the discount. Patience can pay off. Now imagine combining this discount with investment property tax planning. That is your next big tax lever. Stay tuned. Negative gearing can turn an investment property loss into a tax deduction. Imagine buying a rental property with a loan and real expenses. To rental income and costs, if you are $20,000 in the red for tax purposes, that loss may reduce your taxable income by the same amount. 37% marginal rate, that $20,000 loss could reduce tax by about $7,400 before Medicare effects. But remember, it is still a loss. If you earn $85,000, your top rate is 30%. The same $20,000 loss could reduce income tax by about $6,000 before Medicare effects. Selling later? Capital gains tax can apply, but if you hold an eligible asset for more than 12 months, the CGT discount may reduce the taxable gain. Negative gearing only works with a plan. Do not buy a bad property just to get a deduction. The numbers still need to make sense. Now you have seen negative gearing. Next, the structure strategy. Powerful for some people, dangerous if copied blindly. Discretionary trust may allow business or investment income to be distributed to eligible beneficiaries in lower tax brackets. If you run a business or investments through a trust, an adult family member on a lower income may receive distributions, but it must be real, documented, and compliant. Earner. Be careful with children. Minors face special tax rules, so distributing income to kids can create a tax trap very quickly. Trusts may also help with asset planning, but they come with setup costs, accounting costs, legal rules, and ATO scrutiny. This is a growth strategy for established investors and business owners, not beginners. Coming up, the trade-off nobody talks about. Now, the trade-off nobody talks about. Deductions reduce taxable income, but offsets reduce your tax bill dollar for dollar. You earn up to $66,667. The low income tax offset may reduce your tax bill by up to $700. For eligible seniors and pensioners, the seniors and pensioners tax offset may reduce tax even further, depending on income and circumstances. Old Almato ended after 2021-22, but Leto and Sapto still exist, so make sure you understand which offset actually applies now. Use the ATO's tax withheld calculator to check whether your employer is taking out the right amount, not too much and not too little. Offsets are instant wins, but timing your deductions can boost your result even more. That is coming up next. End of financial year is like a tax deadline you can actually use. Here is your sprint to the 30th of June. Pay for a genuine work-related course or buy eligible equipment before the 30th of June. Items over $300 usually need depreciation, not an instant full deduction. Top up your super before the 30th of June if it suits your situation. For personal deductible contributions, lodge a notice of intent with your super fund and get acknowledgement. Investors may prepay eligible investment interest or insurance, but the rules are specific. Check with an accountant before relying on that deduction. Do not rush into dodgy investments just for a deduction. Spending $1,000 to save $300 in tax still leaves you $700 behind. Timing gets you ahead, but there is one more move that could protect your whole tax plan. Coming up next. Before you get too clever, watch out for common traps that trigger ATO attention. Claiming $5,000 in random expenses without receipts might seem harmless, but it can create penalties, interest, and stress. Do not forget to declare bank interest, dividends, crypto gains, side hustle income, and rental income. The ATO already receives a lot of this data. Best tax strategy is one that can withstand an audit. Keep your records clean, organized, and easy to explain. Keep your tax records for 5 years in most cases. It is your best defense if questions come later. There is a smarter way to make all this easier. Plan before June 30th, not after the financial year is already gone. Here is your one action today. Check your supercap in MyGov, call HR about salary sacrifice, or book an accountant. No excuses. Take it now. Think about it. Every year you ignore super planning, deductions, and records. You may be handing the ATO money you could have legally kept. Pick up the phone. Ask HR about salary sacrifice for your super. It can be simple, but make sure it suits your cash flow first. Now log into your super account. Check your employer contributions, unused cap, and whether an extra contribution makes sense for you. Remember, no single strategy is magic, but combined salary sacrifice, carry forward super, clean deductions, smart CGT timing, and good advice, that is wealth planning. So take that one action today. Save tax legally, keep better records, and make your money work harder. Start with one smart move, then build from there.